Welcome to the deep dive. Today, we're going to dive into the world of hedge funds. You know those kind of like mysterious investment vehicles that always seem so
Yeah,
secretive?
they definitely have a certain mystique about them.
Right. So we've got a great article here that really breaks down, what they are, how they actually work, and the potential rewards, and of course, the risks that come with the territory.
Can't forget about the risks.
Right, exactly. So to help us navigate this whole complex world, we have our expert guide here, ready to dive in.
Absolutely. Hedge funds are fascinating because they operate with like a different set of rules than what most people are used to.
The article compares hedge funds to like these exclusive clubs, not just anyone can join, right?
That's right. We're talking about accredited investors, individuals or institutions with a high net worth. Unlike mutual funds, hedge funds face less regulatory oversight. That means higher risk, but also the potential for higher rewards.
So what makes these high rollers want to join these exclusive clubs? What are they hoping to gain?
It all comes down to the strategies. Hedge funds aim to outperform the market even when it's heading south. They don't just ride the wave, they try to create their own. For example, think about the 2008 financial crisis. While most investors were experiencing significant losses, some hedge funds actually made money by betting against the housing market. That's the kind of strategy that attracts big investors.
Wow, that's interesting. The article mentions four main hedge fund strategies: long-short equity event-driven global macro and relative value. To be honest, those terms sound pretty intimidating.
I understand. Let's break them down. Think of it like a toolbox. Each strategy is a different tool for a specific job.
Okay, that makes sense. Let's start with long-short equity. What does that actually mean?
Essentially, it's betting on some stocks to rise going long while betting on others to fall going short. This allows them to potentially profit in any market condition, whether it's going up, down, or sideways. For example, a hedge fund might go long on a tech company they believe is undervalued, while simultaneously shorting a competitor they believe is overvalued.
So they're hedging their bets, as the name hedge fund implies. What about event-driven strategies? Those sound pretty action-packed.
They can be. These funds capitalize on major corporate events like mergers or acquisitions. A great example is Pershing Square Capital Management. They made billions betting on the merger of pharmaceutical giants Allergan and Actavis. They saw the potential, bought up Allergan stock, and reaped huge rewards when the deal went through.
Wow, that's a pretty high-stakes game. What about global macro? That sounds even bigger.
It is. Global macro funds focus on worldwide trends, like shifts in currency exchange rates or commodity prices. Imagine a fund that predicted the rise of China's economy back in the 90s. They could have made a fortune investing in Chinese companies and assets as their economy boomed. Of course, it requires a deep understanding of global economics and politics to make those kinds of predictions.
It sounds like you need a crystal ball to be successful with that strategy. All right, last but not least, we have relative value strategies. What makes them unique?
Relative value is all about finding pricing discrepancies between similar assets. It's like bargain hunting for the financial elite. For example, a fund might find two bonds with similar risk profiles but different prices. They'd buy the undervalued bond and short the overvalued one, hoping to profit from the price difference, eventually correcting itself.
So they're kind of like financial detectives, looking for those hidden opportunities. It sounds like each of these strategies has its own unique set of complexities and potential rewards.
Yeah.
But the big question is, do hedge funds actually live up to the hype? Do they deliver those outsized returns everyone talks about?
Well, according to the article, hedge funds have actually outperformed the stock market over the past couple of decades. They've averaged a 9.4% annual return compared to 6.2% for the S&P 500. On the surface, that's pretty impressive.
But I have a feeling there's more to this story, right? Nothing in finance is ever that simple.
You're absolutely right. Those returns come at a cost. And it's not just about the high risk involved. Yeah, you mentioned cost. I'm guessing those hefty fees everyone always talks about with hedge funds are a big part of that.
Exactly. We're talking management fees that can be 2% or higher, plus performance fees, a percentage of the profits. Those fees can really take a big chunk out of your returns.
Right. Think of it like this. You could have a fund that returns 12% in a good year. But after fees, your net gain might only be closer to 8 or 9%.
That makes a big difference. So let's talk about the risks. The article mentions several, and I'm sure our listeners want to know what they need to be aware of.
Absolutely. First, there's liquidity. Getting your money OUT of a hedge fund isn't as easy as just selling stocks. You could be locked in for a certain period, unable to access your investment. Imagine needing that money for like an unexpected expense or something. That illiquidity could become a major problem.
That's a good point. something most people probably don't even think about.
Right. Then there's complexity. The strategies are often so intricate that it's really hard for people to understand what they're actually investing in. You need to trust the fund manager, but blind trust can be dangerous. It's crucial to do your homework and make sure you at least grasp the basics of their approach.
Due diligence is key in any
No,
investment.
of course. And we can't forget those high fees. They're a constant factor to consider, especially when comparing different funds. And then there's the issue of leverage.
Leverage. That's one of those terms that can be a little confusing. Can you break it down for us?
Sure, think of it like this. Hedge funds use leverage to amplify their potential returns. Imagine they have $100 million to invest. Instead of just using that, they might borrow another $100 million, giving them $200 million in buying power. If their investments go up 10%, they make $20 million instead of $10 million, doubling their profits.
So leverage is like a multiplier for their gains. But there's a catch, right?
Exactly. Leverage magnifies losses just as much as gains. If their investments drop 10%, they lose $20 million instead of $10 million. It's a double-edged sword. And it's one of the reasons why hedge funds can be so risky.
That's a clear explanation, thanks. So if someone is considering investing in a hedge fund, how should they go about choosing the right one? What are some of the things they should be looking at?
The article highlights a few key areas to focus on. First, you need to understand the fund's investment strategy. Does it align with your financial goals and risk tolerance? Do you even understand it? If the strategy seems too complex, it's probably a good sign to walk away.
No one wants to invest in something they don't understand.
Right. Then look at historical performance. Past performance isn't a guarantee, but it gives you some insight into the fund manager's track record. However, it's important to consider the overall market conditions during those periods. A fund might have performed well during a bull market, but how did they do during a downturn? That's a key question to ask.
That's a smart point. So it's not just about the numbers, it's about understanding the context behind them.
Exactly. Next, you need to scrutinize the management team. Who are these people? What's their experience and their reputation? Do they have a history of ethical behavior and sound decision-making?
It's all about trust. But as you said earlier, it needs to be informed trust.
Absolutely. And finally, carefully examine the fees. Are they reasonable compared to other funds with similar strategies? Don't be afraid to shop around and compare different options.
So it sounds like choosing a hedge fund is a lot like choosing any other investment. You need to do your research, understand the risks, and make sure it aligns with your overall financial plan. But hedge funds seem to have like an extra layer of complexity and risk compared to, say, investing in a simple index fund. What are your final thoughts on hedge funds and who might they be right for?
Well, hedge funds are definitely a specialized area of investing. They're not for everyone. The high fees, complexity, and risks mean they're generally more suited for experienced investors with a high net worth and a higher tolerance for risk.
So they're not exactly for like your everyday investor who's just starting out.
No, not really. They're more like a high-performance sports car. Powerful, but they require a skilled driver. You know, an individual investor who doesn't understand all the ins and outs of hedge funds could end up losing a lot of money.
Yeah, that's a great analogy. So for someone who's intrigued by hedge funds, but maybe they don't have, millions to invest, are there other ways to kind of gain exposure to those types of strategies? Are there any options for the average investor?
There are a few. Some mutual funds try to replicate hedge fund strategies. Although they're subject to more regulations and often can't use leverage to the same extent, those funds might be worth exploring, but remember, they won't necessarily deliver the same returns as a true hedge fund.
It's all about managing those expectations.
Right, exactly. And remember, no matter how enticing those potential returns might seem, it's crucial to work with a trusted financial advisor, someone who can really guide you through the complexities of hedge funds and help you decide if they're like an appropriate investment for your specific situation.
Sound advice. So for our listeners out there, if you had the opportunity to invest in a hedge fund, would you take it? Something to ponder. Until next time, keep diving deeper.